The title of our next session is Confronting Disruption. I would now like to invite the speaker for this session, Mr. Lutfey Siddiqi. Mr. Lutfey Siddiqi is Managing Director, Regions and Society Relations at CFA Institute. He is a visiting professor in practice at the London School of Economics and an adjunct professor at the National University of Singapore. He is a member of the World Economic Forum Future Council on Fiscal and Monetary Policy, having previously served on the councils for future of financing and long-term investing. Mr. Siddiqi, the floor is yours.
Thank you, Mr. Lunker. Can you hear me?
Yes, sir.
Okay, great. So good afternoon, everyone, from here in Singapore, and thank you for giving me this opportunity to speak to you. Almost exactly a year ago, Singapore announced a temporary ban on flights from mainland China, having recorded 11 cases of coronavirus that week. And that marked the start of an episode, a global crisis, the scale and range of which hadn't been seen in living memory. A year later, literally today, I'm reading about GameStop, Reddit, Robinhood, 3 words that I would not have expected to dominate headlines in our profession. Disruption is not a recent phenomenon. If we cast our minds back to pre-COVID, do you remember what the world looked like on New Year's Eve in December 2019? 2019 had already seen the slowest growth in world GDP since the global financial crisis. The IMF had already downgraded growth forecasts several times. Both the Federal Reserves and the European Central Bank, having tightened monetary policy prematurely in 2018, had reversed track by 2019. And Japan, of course, remained on full quantitative easing mode throughout this time. The trade war, remember the trade war between US and China? That had disrupted supply chains all over and was still about a month away from reaching an awkward truce, what they called a stage 1 settlement. Many countries, and including China, which has a disproportionate impact on both global growth and global trade, were grappling with internal imbalances. So the first point I'd like to make is that we weren't exactly fighting fit from a macroeconomic point of view going into the COVID crisis. What was the other vector of disruption that was already upon us? The 4th industrial revolution. For almost a decade now, we've witnessed the forces of extreme automation and extreme connectivity, more recently powered by machine learning, upend business models, consumer expectations, and behavior. CFA Institute's Future of Finance initiative has written extensively on what that means for the future of our profession and us as professionals. And I'm sure our colleagues and friends in the society would be more than happy to engage with you on that if that's of interest. If you compare the top 10 largest listed companies from 10 years ago to the top 10 today, you'll see a dramatically different picture. Uberization, platform revolution, servicification of products. These words have swept into the mainstream of business models at a dramatic pace. In terms of market cap, Netflix or even Zoom today is worth more than ExxonMobil. It's hard to imagine that Walmart and Amazon were neck and neck just a year and a half ago. And we know the story of Tesla versus the other car companies combined. In fact, there have been more than one phase of disruption in just the last decade. Think about the X-ray specialist, a hypothetical radiologist working in some remote location, empowered by file transfer technology, because they could now read X-rays sent to them from any part of the world and give their opinion. That same radiologist is now being disrupted away by diagnostic technology powered by artificial intelligence. The demands on all of us to be agile and to be able to pivot are extreme. And then what COVID has done is accelerate many of these trends, but at the same time, it's overturned some taboos and some resistances that may otherwise have slowed down the pace of disruption. And let's not forget the flood of quantitative easing unleashed in the past year, which will continue financial repression, negative interest rates in many parts of the world, and in many markets in which the authorities, who are supposed to be the referees, have come down to play. And macro trends have implications for the micro at the company level, or for us as individual professionals. This is a period of radical uncertainty, to use the title of an excellent book by John Kay and Mervyn King that came out last year. Radical uncertainty. And how is that different from straightforward risk? In a few ways. Firstly, we're no longer in a world of extrapolation. I remember the time when strategy was really about grabbing market share. You found out who had a bigger market share than you, and then you sought to close that gap by outrunning your competitor, but in a market that was fairly static in shape. Today, competition happens on the boundaries of what defines your market. Think about Nokia or BlackBerry against the iPhone, or more recently, a Rolex watch against Apple Watch. With uncertainty, there is no drop-down menu of strategic choices. Everyone is at the frontier. Everyone is having to reimagine their vision. It's also a world where grand theories and ideologies have to give way to trial and error, micro experiments, and a plurality of models. Try, test, feedback, retry. It's a world that's so different from the normal distribution that it almost doesn't make sense to talk about averages. In fact, concepts such as the Sharpe ratio or other reductionist forms of analysis that focus on just one or two summary variables are no longer effective. This is a non-linear, multi-dimensional world, and we need a full dashboard. Lazy linear models are not fit for purpose anymore. It's a world where optimization and the continuous pursuit of efficiency, which we got used to for a while, that needs to give way to more optionality and more deliberate slack in the system, because that contributes to risk resiliency. And we saw the value of that in the last 12 months. It's a world of information overload and misinformation all around. And in that world, if you're a trust maker, if you're a taste maker, if you're a context maker, then you're valuable. All right, so what's the best way to cope? Is there a way to cope without getting motion sickness? I don't want to violate my own rules stated earlier that simplistic solutions can be unhelpful, but let me suggest two words that I believe are necessary conditions. Not sufficient, but necessary conditions. The two words are purpose and inclusion. Corporate purpose, if co-created in the right manner, that appeals to personal purpose, so not just taglines created by the marketing department, they can really provide touchstones when strategy and operating plans might seem to be in a state of flux. Purpose is important. And radical uncertainty also puts a premium on diversity and inclusion. Not just because it's the right thing to do, but it's also the prudent thing to do from the perspective of opportunity scanning and risk mitigation. Both purpose and inclusion, of course, provide the added benefit of employee engagement. Recent trust surveys show that businesses have now supplanted governments in the trust rankings for the first time ever. At a macro level, inclusion and the wider concept of stakeholder capitalism is a strategic imperative for both companies looking for new markets and for investors looking for new asset classes. So as the world transitions from a with COVID to a post-COVID world, the private sector will need to give a bolder voice to environmental, social, and governance issues. I'll stop here for now. Thank you. I wish you a very successful conference, and thank you again for your time.